Just give me a couple of more minutes before everyone joins. Mika done with 6, 7, 8. Mika,
Yes, Viraj.
cool. Okay, cool. Let's start, yaar. Everyone will come. 2-5 ho gaya already. Considering it's an online one right now, this is what I'm planning. I will complete chapter 6 revision today. Uh, let's see how much time 6 will take. 6 usually takes me a 1.5 hour at least. Based on your mood, we'll see. Or else we can move 7, 8 to next week along with the doubt solving of 6, 7, 8. This is what my plan is. I'll just give you a brief idea about my plan first. Uh, 17th March, 17th May, sorry. I'm planning to have doubt solving for 6, 7, 8. Then we will start with 1, 2, and 4. 24th May. Okay, we'll have doubt solving for 1, 2, and 4. We'll do revision plus doubt solving. I guess doubt solving won't get completed. And I guess you won't be even done with sum solving. This is what my assumption is. But that's what the basic plan is. 31st May, I would like to do revision of I would say 12 and 14. And if doubt solving remains, then some aspects of doubt solving. This one is very, 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 very important. I'm still fine if we guys are not on track for the next 2 weeks. But from 31st May, we're going to start chapter 12, 14, followed by that 9, 10, 11. These are the most important chapters when it comes to CM2. This will literally set your base for every single aspect when it comes to solving, okay? This is very important. So probably let's see 31st May or a week later when we are able to do it. But that's what an overall plan is when it comes to chapter 6, 7, 8. Oh, sorry, when it comes to CM2. Uh, okay, cool.
Wake up and check on her, just to see if she's left me enough wet. It doesn't look like that's enough, though.
Okay. Um, let's start with your chapter 6 first. So,
Just a question.
yep.
So, how about chapter 5? Are we planning to do it later on or something?
I'm not planning to do chapter 5. Chapter 5 was omitted in 2024. However, it got asked in 2024's April attempt. But since the last two attempts, they have not asked any question with respect to chapter 5. So I'm not planning to do it now. Till the last attempt, I was doing chapter 5, but now I'm not because since last 1 year, they have not asked. I think they made a mistake when it comes to April 2024. But apart from that, I think now chapter 5 is gone. It's done and dusted. So I don't want to channelize our energy on something which is not in the potion anymore. Cool? Yep. Yep. Let's start. We'll start with chapter 6. Chapter 6, mean variance portfolio theory. The whole assumption behind this chapter is the entire portfolio buying and selling, whatever you want to buy as a portfolio. For example, I'll just give you an example. There are 3 stocks. Maybe I'll name this as Salazar Techno. Salazar Techno. It's a name of a company which is listed on the stock exchange. There is one name as ONGC. It's a gas company. It provides all oil and natural gas. It's a government-based company. And let's take one good name. Let's take Adani Green. Okay, just giving hypothetical examples. Adani Green on an average have given 80% return with around 70% of volatility. Just giving you hypothetical numbers, please do not go with the numbers. Salazar has an average return of 100% with volatility of being 100%. ONGC is more like a stable company, so 15% yearly return with a volatility of maybe 10%, I would assume. This is expected return and this is your volatility. In simple language, what do you mean by expected return and volatility? It's basically average return you get Okay. And volatility is nothing but your standard deviation, the deviation with respect to your, I would say, mean. So when I say 10% of volatility, that means there is a 66.67% probability that my returns would be between 5% to 25%. And X bar plus or minus 3 sigma gives you around 99% of, I would say, 99.7% of accuracy when it comes to overall volatility. Okay. So when I say 10% of volatility, I mean that the share price can go up and down, and the returns you get in a year is either 5% to 25% range with 66.67% of probability. This is what I mean when I say volatility and interest rates. So the plan or the entire objective when it comes to the mean variance portfolio theory is simply that you make your expected return and volatile or and your investment just basis expected return and your volatility or your variance. Okay, nothing else. Um, when it comes to a logical understanding perspective, I think this is a very bad approach. Being very honest, you need to see various factors coming into the picture. Okay. For example, right now, currently, we are standing in a war-like situation. Since we are standing in a war-like situation, I feel that the companies, I would say, the companies which are into high-end luxury kind of a products are not going to grow. uh, Example, Indian hotels. Indian hotels is a group of chains of hotels, which basically caters to Indian as well as the foreign markets. I would name another as maybe just giving a random example, Gucci. You name other any good brands which is like considered to be very lavish are not going to grow in a war-like situation. But in a war-like situation, which companies usually grow? We assume DMart. DMart is in market, it's called Avenue Supermarts. That's nothing but the name of DMart. You can say Reliance. Uh, you can say Adani Green. Adani Green is nothing but it basically produces electricity uh, on renewable resources, which includes your solar panel, wind, I would say, and other solar panels. Then you have hydroelectric water. You have electricity through, I would say, air or so many other ways. Okay. So basically, these are some necessities which are going to be required in an economy. So that's not going to go away. Um, so you have Avenue Supermarts, you have Reliance, you have HAL. HAL is a company which makes, I would say, defense products. So currently in a war-like situation, I would expect these companies to go up because, as you know, government is having a meeting tomorrow as well with these companies in order to advance our internal systems to provide a better protection to the Indian borders. Okay. You have Cochin Shipyard Limited, you have Musgao Docks, and so on. So these are the kind of companies which are expected to grow. The defense related companies, the government companies, as well as the necessity companies, which is like a necessity. Okay. Electricity, water, food, anything related to that are considered to be a necessity in a war-like situation. So just basically just giving an expected return and volatility does not make logical sense when considering an investments. Uh, so to be very honest, this is a very bad approach, but it is very popular when it comes to understanding the overall markets. Okay. So the first 8 chapters, as you know, we are going to study more related to the markets and how are we going to make investment and something like that. Um, so kind of, I would say this is what we expect. Uh, this is what we expect around the markets, okay? And this is the first step in order to analyze your investment and make your investment in the best possible way. I'll give you a few key insights based on my personal experience as well when it comes to investments around how you need to go about it and everything. You can use it real life, but it can be asked in your theoretical exam as well. Just giving you overall perspective about what are we going to do when it comes to investments, money, and everything. Okay. Starting with the important point, I'm going to start with, I would say, assumptions. Assumptions. of MVPT. That's what I'm going to start with. Again, these assumptions, I have written a few assumptions, but few assumptions are not written in the notebook. So just make sure you note them down, okay, right now. Starting with the first one, just giving someone a chance. Yeah, Angi, can you tell me, please, some assumptions of MVPT? A couple of them, please.
So the first assumption is that for a given level of expectations, we would like to minimize our variance.
Minimize your variance, okay? That's basically known as risk averse. An investor is a risk averse individual. For example, you have 10% return, 10% return. One has volatility of 7%, one has volatility of 5%, but you will always choose 5% because you are a rational person, which basically goes for lower risk for same level of return. Okay, makes sense. Second,
So me only.
yeah, obviously you.
For a given level of variance, we would like to maximize our expected returns.
Yeah, perfect. So that is basically the terminology here is non-satiated. This basically indicates that if you have, for example, 10%, for example, the volatility is 7% both, and you have an option to get 10% return and 6% return. You'll obviously choose 10% return, more return over a fixed level of variance. Okay. Makes sense. Mm, Vama, can you tell me a few more assumptions, please?
The investment decisions are solely based on two things, that is the expectation and the variance. That
Yes,
would
it's
be my main
basically based on expectation and variance. That's absolutely right. Then, any other assumptions which comes in your mind?
um,
One important assumption is all expected return, variance, and your covariance values are known to you. When I say known to you, for example, if I assume that Reliance will make a 10% return with a 7% of volatility, okay, I will also have the same expectation. Vama also has the same expectation. Angi also has the same expectation as with the rest of us as well. So this is what the basic understanding is. Whenever I say expected return, variance, and your volatility or your, I would say, your covariances between the assets are known to you. Okay, everyone has the same expectation around us. Cool. Uh, Sneha, do you want to give it a try for other assumptions, please?
in case of like if we have two assets, so we'll go for the asset investment which has the lower variance.
Again, that comes under non-satiated. कुछ और दो, if you can think of anything else. Okay, this is done in a fixed time step period. Okay. What do you mean by this? Fixed time step period. I basically mean that, for example, this 10% return is for 2025 year or 7% volatility is for 2025 accounting year, that is from 1st April to 31st March. This is what my assumption is when it comes to this, but it is for a particular year. That doesn't mean that 10% happens infinite for an infinite period. Okay, I do not mean that. I mean for a particular year, which is known to us and which has same expectation across all individuals. So even I'm expecting 10%, you will also expect 10%. That's what the basic assumption is. Uh, okay, moving to next point now. Okay, just open now. If anyone has any other pointers, they can let me know. Any other assumptions which you want me to know, please do let me know. Or else I'll tell you.
There are no
Open.
taxes and transaction costs.
Yeah, that's the most important one. Taxes and transaction costs are involved. Uh, Usually the taxes in India is 20% of capital gains tax. Capital gains tax in simple language is nothing but uh, I would say, for example, 1 lakh rupees of investment you did, you made a profit of 1,20,000. 20,000 you get taxed at 20% straight. There is other things as well. I do not want to get into the nitty-gritties of taxes because that's not in the scope of our portion. But there are some exemptions as well, and there is some short-term capital tax as well. If you sell below a year, you get taxed on short-term taxes. If you sold above a year, you get capital gains tax, which is usually around 20% in India. Transaction cost on an average is 0.25%. Zerodha charges 0.25% on buy and sell. Uh, so that's what the transaction cost is. Zerodha is the cheapest, I would say, way to buy and sell, to be very honest. Everyone else is above that, okay? So this is the cheapest one, but usually it goes 0.2 to 0.8% is the average range on buy and sell we usually have to pay when you buy and sell, okay? So around 0.4% while buying, 0.4% while selling. We are not assuming that. When I say 10% return, I mean net gross of tax, gross of your transaction cost as well. We are not assuming transaction cost or transaction taxes under any circumstances. Okay, any other assumptions?
Maybe the ability to short sell.
Yeah, that's a very good assumption. Short sell. In an Indian market, short selling is not possible. So, for example, if I feel that due to the war, let's assume which stock do I pick up? Let's assume ICICI Bank, okay? ICICI Bank will basically collapse or basically won't perform well because my logic behind this is since war is going on, people will remove a lot of money from their account. If people remove a lot of money from their account, they keep it in their pocket. What happens is banks have less money to give as loan, or people do not even take loan in a situation like this. So obviously they won't make profit. That's the reason I feel the profit is going to decline and hence the share price is going to decline. So that's why I think it's going to decline. What do I do is I short sell. Right now, ICICI Bank is, for example, 1700 rupees. So I sell first, I get 1700 rupees. I buy later. I buy later at maybe I say 1400 rupees. So at the end of the day, you're buying at 1400, selling at 1700, you make a profit of 300 bucks. That's what the basic assumption is when it comes to buy and sell of a stock. Buy and short selling. You sell first, you buy later. But this is not allowed in an Indian market. You cannot sell a share first and then buy later. That's completely not allowed. But however, under different categories, this is allowed. For example, futures, options, is somewhere you can sell first and buy later. Again, what is futures? What is options? I'm not getting into that right now. This would be covered in chapter 12. This concept is very important and your CM2 is all related to these concepts only, futures and options. Okay, we are going to go very much into the detail. Uh, giving, yeah, that's around your futures buy and sell, to be very honest. Okay, let's get into a few notations here. Notations, I would say W is known as your initial wealth, and your RP is known as return on an asset on my portfolio, and R1, R2 is return on my asset 1, asset 2, and asset 3, so on. I'm not getting into the details now. What I'm interested is in the formula. So yeah, Sneha is done. Krisha. Krisha, can you tell me the formula for expected return of your portfolio? Can you tell me the formula for variance of your portfolio, please?
The expected return of the portfolio is equal to summation of xi rn, the variance of the portfolio.
Sorry, summation xi into, I was not able to hear you pretty well.
Xi into rn.
Ri, are you sure this is the notation?
Rn.
No, it's EI. Xi into EI basically means X1 into expected return of asset 1. X2 means proportion of asset 2 into expected return of asset 2, and so on till your N assets. Sorry, if I heard you wrong, please apologize, but that's what I heard, okay? Variance of RP, please.
Variance is equal to summation of xi, xj, and the covariance.
Two summations, summation of I, summation of j, xi, xj, cij. For a two asset case, can you tell me what would be the variance?
For a two asset case, the variance would be xi square plus x1 square plus x2 square plus 2 x1 x2 into Cij.
Okay, you understand the notation. X1 square into V1 plus X2 square into V2 plus X1, X2, C12. You need to be specific. You can't write INJ. INJ is generally the notation, okay? You need to be specific here. Just remember that. Uh, okay, so basically this can be done with respect to a covariance matrix. Covariance matrix is nothing but, for example, x1, x2 till your xn, x1, x2 till your xn. X1, x2, x1, x1 is C11, which is also known as variance of asset 1. X1, x2 is known as C12, and so on. Okay, diagonal values would be V1, V2 till your Vn. Okay, so it is addition of your variances. So it is nothing but, I would say, addition of your variances and two times into covariances. Two times, because C12 gets repeated here and here. So two times summation of your covariances. That's what the overall understanding is. I did not make the proportions right now, but just giving you a brief idea about how this came into picture. Okay, I think you are pretty clear, but just repeating things once again. That's it. Uh, so yeah, this is nothing but a few notations. Okay. Can you tell me relationship between XA with respect to variance and covariances, please? Uh, Maybe Neeti, can you give it a try? Relationship of your proportion of your asset A with respect to variance and covariance. That's what the question is.
Which one of the two of us?
Neeti, Neeti Shah.
Okay, yeah. Um, the relationship with respect to XA will be that variance of, wait, you are talking about that formula, right? Variance of B, that one.
मुझे नहीं पता मैं आपको पूछ रहा हूँ.
Okay, XA is equal to variance of B minus 2 covariance of A and B upon variance of A plus variance of B minus 2 covariance of A and B.
Just a mistake. Variance of B minus covariance of AB, not two times. Variance of A plus variance of B minus 2 covariance of AB. Okay, cool. The proof
Yeah.
what we did for XA is very important. Please hear me out here. In case if you want to use this formula, if it's a question of 1 or 2 marks, in that case, you can directly use this formula. I do not have a problem with that. But if in case the same, you have to find a proportion with respect to variances. If in case there's a question of greater than 2 marks, then first you have to prove this and then show that what would be the value of XA, maybe 40%, 50%, whatever it is, based on whatever you substitute. But anything greater than 2 marks, the proof which we have done it in the notebook, it is compulsory for you to show. 1 or 2 marks, if you have less time, it's okay, you can skip the proof. Okay, but my recommendation if in the question this formula has not been mentioned, then automatically you have to compulsory do the proof. 1 or 2 marks is less marks, so I don't think so proof will be required 99% of the cases. But anything greater than 2 marks, I would 110% suggest that this proof is compulsory to show. Okay, that's around an understanding when it comes to getting XA, the proportion of asset A, proportion of asset B, variance of B, covariance of AB, and so on. A short selling concept, just a quick revision. Short selling is you sell first, buy later. The whole purpose of this is whenever you want to make a profit when you think that share price is going to decrease, okay, is nothing but you sell first, buy later. Uh, Giving you an example, uh, for example, I short 2 kgs of gold. 2 kgs of gold today is worth around 2 crores, for example. Uh, and it's 1 lakh rupees per 10 grams, right? So, for example, now this price goes to 97,000. Okay, 97,000 is the price it goes to. So, your overall, I would say, 1 lakh decreased to 97,000. So, you make a profit of 3,000 per 10 grams. That means you make a profit of 6 lakh rupees if you have shorted a 2 kg of gold. Okay, overall in this scenario. Just giving you a few insights about what happened in the market over the last few weeks. Uh, Gold in 2021 on an average gold price was around 55,000. In 2025, it has reached to almost 1 lakh. Again, this is what my projection is. I'm not telling you to do anything, just telling you out of my understanding. Year on year, if you see, year on year, gold is making 25% return. Being very honest, 25% return on a gold is not a good return. Again, if you have gold, you'll obviously feel it's good, but my perspective is 25% is not sustainable over the long term. Uh, the understanding is this has increased 25% year on year because of a few reasons. First is your Russia-Ukraine war came into the picture. Um, your COVID came into the picture, which caused a lot of uncertainties. Now India Pakistan is obviously going on, but that's very late. 1 lakh happened before India Pakistan. Important thing is Trump tariff came into picture. Uh, any other economic scenario which I'm missing? I don't think so. There were no major unrest. Whenever we expect things to be unrested in an economy, we always expect gold price to rise. Uh, since the last 4 5 years, we have seen a lot of uncertainty when it comes to the economy. That is the reason why we are getting a year on year of 25%. Once the things get to stabilize, that means that the economy runs on usual. There is no major changes in the economy. People are happy and everything. This is what my expectation is. I've read a few reports. We are expecting gold to reach around 80,000 back. Uh, Again, this is my expectation. I don't know what the things will basically turn out to be. If the things escalate between India and Pakistan, gold is going to be even further rise greater than 1 lakh. If things get normalized, gold price is going to go down. The only reason is because of the uncertainty in the economy. And as people say that if you might have seen that your stock exchange have almost grown double, where the potential is even greater than that. People have parked more money in gold, and if people sell gold, obviously the difference amount of money comes into the stock exchange, and therefore stock exchange rises whenever there is selling in gold. So you might have seen these two relationship. I don't know whether you track markets or not, but just giving you my insights. Whenever your gold decreases, your stock market almost all the time it basically increases. Okay. uh, that's what an understanding is. Let's see what happens over the future when it comes to this scenario. Okay. Now, talking about two asset case, I'm going to ask a few conceptual formal understanding first, and then I'm going to move ahead with this. Two asset case. Two asset case, basically what you draw is you draw a graphical representation of volatility as well as expected return. Expected return of your portfolio, volatility of the portfolio. Now I want you to answer a few concepts. Okay, I'm just naming this one opportunity set. What do you mean by opportunity set in the first place? Devraj. First of all, have you done Devraj 678?
Hello.
Yeah, did you complete 678?
Yeah, sir, done.
Can you tell me what do you mean by an opportunity set?
Opportunity set is the C curve, right?
I don't know. You are going to tell me.
Yeah, so it's the C curve that is there and उसके ऊपर फिर on it the various क्या बोलते हो expected return on portfolio and variances we point, no?
ठीक है, you're almost right, but in a more precise way, if I were to say, opportunity sets is nothing but all the available combination of a security, okay, in an expected return volatility space. That means, for example, these are nothing but the opportunities which is available. Okay, so all these pointers are nothing but the opportunities, and therefore this is nothing but an opportunity set. Perfect. Yeah, good. Mika, can you please explain me what do you mean by when a portfolio is efficient? What do you mean by an efficient portfolio? Mika, I can't hear you. You're on mute. Mika, I can't still hear you. If you're there, please text me.
Yeah, I'm here. Efficient portfolio basically means um, when variance is minimum and expected return is more.
Okay. Just this one scenario. You told me higher mean, okay, for a lower variance. Is this the only scenario? Means you can say it vice versa as well. Lower variance with same or higher mean. So for example, an efficient portfolio is a portfolio where there are no portfolios available with higher mean, okay, higher mean with same or lower variance. So there should be no portfolio which is available which has higher mean with same or lower variance, okay, or lower variance, okay, with same or higher mean. If I were to say you in simple language, these portfolios obviously have higher return for same level of variances. Okay. Therefore, this is known as your efficient portfolio. Okay. Particular portfolio is known as your efficient portfolio. Now, what do you mean by an efficient frontier? Just giving someone else a chance. Shashendra, what do you mean by an efficient frontier? Efficient portfolio, we understood it's a portfolio where there is no portfolio with uh, higher mean with the same or lower variance or lower variance with the same or higher mean. But what do you mean by an efficient frontier?
Yeah, isn't that just the line,
Yeah,
the top half of the C? So it's the
yeah,
collection of
perfect.
portfolios that
Efficient
represent.
portfolio is a single portfolio. Efficient frontier is a line of possible assets based on the risk appetite of an individual. Just giving you an hypothetical scenario here. For example, let's consider three family of mine. Okay, that's me. That's my father, for example, and that's my grandfather. Okay. Considering me, I'm kind of a person where I would want to take more risk because I'm at that age where I feel that if I want to build a larger portfolio for myself, I want to take more risk. So I will be a person, I'll be making investment here where my mean is also higher, volatility is also higher, but I'm fine with the volatility because I want to take more risk because I have more years with me in order to basically own and do stuff. Okay. From my father's perspective, my father is, for example, 50. Hypothetical example. 50, he will retire in 10 years span. He also has a few liabilities which he has to pay off. Just giving you a hypothetical example, please do not get into the nitty-gritties. For example, there might be, I would say, my wedding he needs to pay off. There might be a home loan on his head. Whatever it is, I'm just giving an hypothetical scenario. Two simple things. So what happens in the next 5 years? He wants to use that money, what he has saved, right, for a particular purpose. Since he want to save that money for a particular purpose, uh, I would say that he will tend to be a person where he will be standing maybe here, where he wants a decent return, but also less risk when it comes to the scenario. Okay. Uh, Now, if you talk about my grandfather, for example, my grandfather is about 85. Most of his assets, okay, he will keep in an FD, which is the lowest point of your volatility. The only reason is he might have a few other expenses, for example, medical expenses in case of an emergency or XYZ, whatever the scenario is. So depending from person to person, a person might be standing here, might be standing here, might be standing here. It doesn't mean that overall that this is the only portfolio which you need to buy. This is the right portfolio. This is the right portfolio. No, all of this portfolio in the blue highlighted line are considered to be the right portfolio. Depending upon the scenario of an individual or a perspective of an individual, this might change from person to person. Okay, therefore, all the portfolio are considered to be the right portfolio. Again, there's no right or wrong here. Based on your risk appetite, you should basically take your investment decisions. This is basically known as your efficient frontier. What do you mean by an indifference curve? Okay, indifference curve. I guess Shashendra has an answer. Let's ask someone else. Neeti Jain, okay. Uh, can you tell me what do you mean by an indifference curve, Neeti, please?
Yeah, sorry, sir, could you repeat?
What do you mean by an indifference curve?
Sir, actually, I haven't seen that video.
आपने क्या क्या किया अभी तक? You did chapter 6, 7, right?
I did chapter 6 like 4 videos, like 2 are
हाँ,
left.
4 videos में है. We are still on the second asset case only.
But I haven't seen it.
You tell it's okay, you don't know, that's fine. Indifference curve is simply these are the points, right? ये points को join करने वाला जो line होता है, that is known as an indifference curve. The line joining all the possible assets of an opportunity set is known as an indifference curve. So opportunity set is nothing but the pointers. Line joining the pointers is known as an indifference curve. Okay. Okay. What do you mean by an optimal portfolio now? Okay. Optimal portfolio, Manpreet. Can you please help me? What do you mean by an optimal portfolio?
Is it the green one?
Not necessary. No, that's not right. Optimal portfolio is nothing but a portfolio which gives an investor the highest maximum expected utility. Maximum expected utility. Utility basically in an economic terms means happiness. For example, I'm just giving you an hypothetical example. Please don't get into the words of what I'm saying. I took an open position in Nifty, okay, and then Nifty crashed. And I knew it was going to crash because of this, for example, India-Pakistan war. Just giving an hypothetical example. I was unable to sleep last night. Okay. However, in the past, I have made good profits, but I was unable to sleep last night because of these position which I took. Okay. Now, does that mean that it has given me the maximum satisfaction, an investment which gives me a maximum satisfaction? No, right? My maximum satisfaction would have been a peaceful night's sleep in simple language. Means if I would have invested in maybe I would say mutual funds, that would have given me a good night's sleep. I wouldn't have cared about my what is happening to my portfolio because I do not have to remove my money. Right? You have to at least do some positions up and down in order to, but I'll make losses. That's definitely for sure. But a good night's sleep for me would have been mutual funds where I just invest and I just forget about that investment. So based on person to person, whatever gives you the maximum satisfaction is nothing but your optimal portfolio, whichever gives you a good night's sleep in simple language. Okay. Uh, for me, it might be XYZ. For you, it might be ABC. It doesn't make a difference. It might differ from person to person, and which is absolutely fine. Just wanted to make a point. Understand the difference. Efficient portfolio is the portfolio which has no level, no lower mean, or no lower variances with the same level of mean, or or there is no possible of higher mean with same or lower variances. Okay. So that is your efficient portfolio. Efficient frontier is the blue line which I have marked. Optimal portfolio is nothing but the portfolio which gives you maximum satisfaction. See, my risk appetite is this, for example. I'm standing here, my risk appetite is this. But if this is not giving me a good night's sleep, then I think I need to move to this green person because that will give me a good night's sleep. Whatever helps you to sleep, that's it. In simple language. So understand the difference between the terminology. They might ask you theory questions. I'm just getting into the understanding as well as knowing what these terminology basically mean. Okay? In case of a two asset case, the following formulas are very important. XA plus XB is equal to 1. That's the first formula. Expected return of portfolio is equal to XAEA plus XBB. Variance of your portfolio is XA square VA plus XB square VB plus 2 XA XB covariance of AB. Covariance of AB is nothing but correlation of AB into sigma A into sigma B. Okay. These are some important formula for two asset case. These are the formula you should 110% know under any circumstances. Okay. Now we are coming to three asset case. Three asset case is usually solved by your Lagrangian function. Lagrangian function, can anyone help me with the formula, please? Neil, can you please help me with the formula, please? What's the formula for Lagrangian?
Yes, variance of portfolio minus lambda 1 expectation of portfolio minus small e, that is actual result, I guess, minus
Actual
lambda
return.
2. Yeah,
It's
actual
actual return.
minus lambda 2 bracket x1 plus x2 plus x3 minus 1.
In case of a three asset case, if there are more assets, this gets added on. Okay. Uh, Hitakshi, can you please tell me the further steps from this point?
Then we'll differentiate with respect to all the assets and the Lagrangian multipliers.
XA, XB, and XC, and all the lambdas value, right?
Yeah, all the lambdas.
Then
we'll put them all equal into 0, and then we'll solve these equations to get the value of XA, XB, and XC.
okay, perfect. While doing one sum in the class, I'm sure I've done that one sum. I might have written a few steps which are very important. Just mark my words right now. The steps which I have written, please follow those steps only. If you follow any other steps, you might get a different answer, and this is considered to be a wrong answer. Even though solving two simultaneous equations, giving you all the values is okay, but following my steps only will give you the right answer, which is expected by the examiner. See, for example, these are the 5 equation I got. Okay, 1, 2, 3, 4, 5. I forgot what my steps were, to be very honest. Just make sure you make a note of it. For example, I told you till what I remember, wherever has the less values of x's, just consider that with respect to the lambda values which is there in that equation. This is what I remember, vaguely remember it. That was the first step. But if instead you took 1 and 3 step, even you solved it, You got the answers as well because these are simultaneous equations. You are going to get answers under any circumstances. You got the answer, but that answer is considered to be wrong as per IFOA. The steps which I have written, it has been trial and tested across all the sums in the past papers with respect to the recent years as well as your revision notes as well. It has been tested. Please follow those steps only. If you follow those steps under all the circumstances, you're going to get the answers. Okay. I know this sounds very wrong. That even if I use different simultaneous equation, they should not be having a problem with it. Whatever the problem is, I don't know. But just letting you know right now, only IFOA gives 0 marks for that, or even IAC gives 0 marks for that. That is very, it is very important for you to understand that the steps which I have written is the only way you need to solve. It is disappointing, but at the same time, it's very important. Okay. Yep. That's around when it comes to three asset case. Now I'll move to the last concept, diversification. I guess, Niharika, you have not done it, so I'm not going to ask you the question. Sai, can you please tell me the input data which is required for analysis, please?
So
When it comes to solving.
input data for expected return is n. So
Mhm.
n of variance is also n, and covariance is n square minus n upon 2.
And the sum would be
And the sum is n square plus 3n upon 2.
n square plus 3n upon 2. So for example, now you have 50 or maybe 50 values of n. You require 1325 values, which becomes very difficult in reality. That's why we use the concept of diversification. What do you mean by diversification in simple language if I were to explain? Uh, for example, I don't know if you know this concept or not. I'll just give you an example. I'll just open it out. Give me 1 second. Nifty 50, Nifty 50 stock and weightage. Okay. So these are nothing but the Nifty 50 stocks. So Titan stock basically has a weightage of 1.63%. So Nifty 50 is nothing but an index, just giving you a brief idea. Nifty 50 is an index which comprises of 50 stocks. Sensex is an index which comprises of 30 stocks. Okay, top 50 stocks, top 30 stocks. Okay, each company has a weightage. For example, there is Titan. Titan has a weightage of 1.63%. Okay, Tata Motors has a weightage of 1.37%, and so on. Even Sensex has a weightage of it. Okay, so based on this weightage, the stock price move up and down. You get basically Nifty 50 going up and down. Okay, that's how your overall analysis is done. Now, what you have done as an investment is, for example, I have 1 crore rupees with me. I invested in Nifty 50. Instead of investing in a particular stock, for example, if I had 1 crore, if I have invested in Adani and tomorrow the company collapses, I lose all my money. But when I invest in Nifty 50, even if, for example, Titan has a weightage of 1.63% only, which is only, I would say, 1,63,000 going into the Titan stock. For example, even if tomorrow Titan stock decreases or maybe it goes bankrupt, only your 1 lakh rupees goes away. Your 1 crore rupees basically is secured. So diversification in simple language is nothing but, I would say, it preserves your money. Mark my word, it preserves your money and gives you stable return. Um, there was a very good quote which Warren Buffett said one time. If you want to make money, okay, you invest in one company. If you want to preserve your wealth, you diversify. What do you mean by this? In simple way, I would say if I had 1 crore, I invested in maybe a good company which has grown very well recently. Um, uh, which is a good company which has given you very good returns. Let's assume there's a company known as Master Trust. Okay. There is a company I have invested, I know for a fact, I'm just telling you. Master Trust in last 1 year had doubled your money. There's one more company known as VFin Solution. VFin Solution has literally 7 times, it has grown your money 7 times in the last 1 year. If you would have invested 1 crore in VFin, you would have made 7 crore rupees. If you had invested 1 crore in Master Trust, you would have made 2 crore rupees. But in the last 1 year, Sensex has given around 20% return. Your 1 crore would have grown to 1.2 crore only. So here, what you're trying to do when you diversify is you're going to preserve your wealth. If you don't want to diversify, you want to multiply your money, you take bigger bets. You go all in for one company. Okay. That's how overall people make money, to be very honest. If you would have seen someone nearby who has made money by stock exchange, they wouldn't have made money by keeping their money in Sensex. They would have made money in a couple of companies only. Like for example, VFin. They would have made that major chunk of money in that one company only. So if you want to make money, okay, you should basically invest in a company or a couple of companies only, maximum four. If you want to preserve your wealth, okay, I feel that you should invest in Sensex. There are other indexes as well. There is mid cap 100 as well. So that basically consists of top 100 companies and so on. There are a lot of other matrices which you can monitor your performance through. But my basic understanding is when it comes to your wealth management, I would prefer you should at this particular age, whatever age you are in, you're still young, you should have 60% of your income in these kind of asset where you want to multiply your money, 40% where you want to preserve your money. So in case something bad happens with that 60%, you have that 40% saving, which you can use for future references. So if you want to be very honest, only one approach is very risky. You should do a balanced approach where you basically bet on a couple of companies and other money you keep it in your, I would say Nifty 50 or wherever you want to keep. I follow this approach only. My percentages are a little bit, or I would say very different as compared to these, but I follow this approach only personally. Some money in mutual funds, which is like growing, which I do not have to see for the next 30 years, and I don't want to have a look. The remaining money, I take very risky bets. It's either zero or it's 10 times, something like that. So that's what I kind of do. I think you should follow the similar approach, not exactly the same, based on the risk appetite from an individual perspective. So if you carefully see now, under case one, when your returns are independent. If your returns are independent, your variance of your portfolio becomes V bar upon N. If N tends to infinity, okay, then your overall variance of your portfolio tends to zero. That means, see, if you would have invested in top 100 companies, Titan would have weighted only 0.2%, for example. So 0.2% your money goes, you don't care really, right? So your volatility almost goes away. So whenever the returns are independent, but in reality, returns are never independent. It is always correlated with the overall market or in an economic scenario. Okay. Case two, which is returns are not independent. Returns are not independent. In that case, who is left? Niharika, Sai, Dan, Swani. Swani, can you tell me what is the formula for returns are not independent, please? Swani, I can't hear you. Swani, can't hear you. You are unmuted. I can see that, but I can't hear you. Simran, can you give it a try, please? Simran, can't hear you still. Is it my PC or what yours? Wait, let me rejoin. Yeah, Simran. No, I can't still hear you. Aryan, please give it a try.
Hello.
Yeah, I can hear you. Suhani, give
So
it a try.
actually,
Give me
I
1 second.
haven't been.
Suhani, give it a try, please. No, I can't hear you, Suhani. Just check your mic. Next time you will be coming offline, so not an issue, but just check your mic overall what is happening, okay? Aryan, yes. Please tell me in what happens in case the returns are not independent. What would be the formula?
Sir, actually, I haven't been able to complete the videos.
Okay, you're not able to complete. That's fine. That's not an issue at all. What did you do up till now? Can you tell me? How much have you
I've just,
completed?
uh, like, I had some family functions, so I've just started like the sixth chapter.
Please ensure you are with me, okay?
Yes, sir, totally.
Yeah, Bhavya.
So even I have not done this part.
Okay, कितना किया तूने?
Last I remember कि वो मैट्रिक्स था 2 केस वाला and उसके आगे से थोड़ा एक दो वीडियोस थे. I don't think
ठीक
so
है,
I done
not
this.
an issue. Please complete it out by next week, okay?
Yes,
Please.
sure.
Bhavi,
Yeah, sir.
बोलो. Returns are not independent. What's the formula?
The formula for variance of the portfolio.
Yeah, in case returns are not independent.
Yeah, V bar by N.
P bar by N
We can't see your
plus.
screen.
Oh, yeah, wait 1 second. You can see it now.
Yeah.
V bar by N, 1 minus 1 upon N into C bar. If your N tends to infinity, okay, this whole aspect goes to 0. Sorry, this whole aspect
C
goes
is
to 0,
0.
this goes to 0. You'll get variance of your portfolio is equal to C bar. Sorry, you were saying something?
Since they are independent, C will be equal to 0, right?
If in case they are independent, then it's basically variance of portfolio is 0. In case they are
Okay,
not
not
independent,
independent. Right. Yeah.
then it will be variance of portfolio equal to C bar. Perfect. Two important concepts before we complete chapter 6, 7. Systematic risk and specific risk. Can you please help me, Bhavi? What do you mean by these two?
Yeah. Systematic risk is the risk related to the entire market, and specific risk is particular risk relating to an asset.
Okay, perfect. Can you give me an example if you can? You can make an hypothetical scenario as well. I'm fine with that.
Systematic risk can be inflation.
Now, how does inflation cause an impact?
Because inflation will affect the entire market.
No, it won't. Just telling you what will happen to inflation. Agar your price increases by 10%, so companies also has to increase their price by 10%. A 100 rupee product is now sold at 110. Okay. If the profit margin initially was 30%, they'll get 30 rupees. Inflation ke baad 30% profit, they will make 33 rupees. So at the end of the day, your net profits. See, if you talk about the yearly terms, it's going to be exactly the same. But when you talk about the numbers, it's going to increase. So inflation actually causes a reverse impact. It's going to increase the market price.
So what about the war going on right now?
That's a war. That's an example. The systematic risk war goes down. Yesterday, the market were down by 1%. Pakistan market were fell by 6.3%. Indian market fell by 1% yesterday. So that's around systematic risk, specific risk.
Season.
How? Elaborate, please.
No, I don't know actually.
Okay. Specific risk is, for example, just giving an hypothetical, Trump basically increase the tariff rates. Okay, Indian was, I guess, 28% till what I remember. I forgot the number. For example, they increased from 14% to 28%. What were the companies which are affected by this? The major companies were the service-based industry, TCS, hai, you have Wipro. So now they have to pay additional 28%, which is going out of their own pocket, right? So because of this thing, if you would have seen, only a particular industry was impacted. The industry was IT sector was impacted. Your automobile sector was impacted. Your jewelry industry was impacted because of the tariff coming into picture. This is the reason why a specific event causes a risk to a specific area of the market, not everyone. That's known as a specific risk. Systematic risk is as a whole, economy as a whole. For example, tomorrow India gets into an unrest situation. Things get escalated. We go into an India-Pakistan war, which is a full-fledged war. We have to close the entire northern states, therefore, which has impacted the entire flow of the economy. That is known as a systematic risk, where whole system is affected because of a particular event. Specific risk, only a particular aspect of the economy is impacted because of change in scenario of a particular aspect only. And that aspect might not be related to your, I would say, asset case altogether. It would cause an indirect impact. Another example of specific risk includes raw material. Tomorrow, for example, raw material prices increases by 50%. The industry which is catering to that raw market will face heavy losses. That is the reason it causes a problem. These are specific issues. Systematic is system as a whole, which causes a problem. That's around for chapter 6. We are done with chapter 6 here. Please go through the chapter. In case if you have any doubts, please do let me know. If not, let's wait for 5 more minutes. Then we'll start with chapter 7. Chapter 7 is the last chapter which I'm going to do for today. Chapter 8, I'll do it in the next lecture. We can take a 5-minute break if you want to. If you have any doubts, you can let me know in these 5 minutes. That's fine.
Sir, if you can you explain the steps for the Lagrangian function again, sir? Because while writing so many numbers, getting a bit difficult.
मेरे को फोटो भेजेगा एक बार लाइक रेंज मेरे नोटबुक में नहीं लिखा हुआ है एक्चुअली.
Yeah, sir, I'll send you the photo.
I did it while I was making the sums, तो मेरे पास नहीं है वो. भेजा देवराज तूने?
Sent.
इसके बाद कुछ नहीं लिखा हुआ है.
No, after that we solve for that x1, x2, and x3, no? So that and lambda part. So that I didn't do because it was getting मतलब थोड़ा bore हो गया मैं तो, so I didn't do that ahead.
वाह,
So I'll do it now.
एग्जाम में यही करके आना. बोर हो गया मैं. हाँ 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 हाँ. So what did we do is, okay. इनको यार ये बंद करना पड़ेगा एडमिट वाला ऑप्शन. I might have something ready. तुम लोग को वन नोट चाहिए फाइल्स इस बार? यस नो?
दे दो सर.
इस बार पॉसिबल है देने का ऐप के थ्रू. आई कैन शेयर इट आउट.
You mean the notes?
या वन, ये वन नोट्स पूरा है.
Yeah, it will be helpful if you can share that.
हाँ ठीक है, I'll share it out.
The app is working, Viraj, or it will take some time.
मतलब आई थिंक मेरा अपलोड मंडे तक हो जाएगा. I'll probably start sharing from Tuesday or Wednesday. That's what my plan is. A couple of days here and there. Yes. So the first step, what we did was with respect to ठीक है. हाँ. What is this? भाई मैंने क्या लिखा है? One, okay. Okay, 1 and 2 I took it. Took the difference between that. Okay, yeah. ये steps है. Just ध्यान रखना. See, what I want is, see, I want x3, lambda 1, lambda 2 together. This is what my third equation basically indicate. नहीं, एक ही सेकंड ना. ये तो मैंने सारे इक्वेशन ही लिखे हुए हैं. Lambda 2 is equal to step 3, input and other terms, substituting equation 1 in equation 2 and 3. Okay, very important step is, see, ये तीनों तीन equation में whichever is the shortest equation you need to consider that. See, यहाँ पे you have x1, x2, lambda 1, lambda 2, 4 values. x1, x2, lambda 1, lambda 2, 4 values. Here you have x3, lambda 1 and lambda 2. There are only 3 possible values. Okay. So what do is you basically write x3. If you see, you write your lambda 2. Lambda 2 यहाँ पे है, दोनों equation में lambda 2 है. Or lambda 1. Okay, that's either way is possible. Lambda 2 is just easier because I don't have to do this calculation. That's the only reason. Always write the smallest equation, the smallest possible equation in the form of lambda 2. That's the first step you will do. Okay. Substitute at lambda 2 in equation 1 and 2. Then you will get an equation in the format of x1, x2, x3 and lambda 1. Right? Similarly, you will get that equation. You subtract your lambda value, get your equation in the format of x1, x2 and x3. Always, always, always. Again, I'll repeat myself. Whichever is the smallest possible value, smallest possible equation, write lambda 2 in the other format. Substitute that lambda 2 in the above two equation where x1 and x2 are. You will get the equation in the format of, and then subtract your lambda 1 value. You'll get the equation in the format of x1, x2, x3. Okay, you'll get one equation in the format of x1, x2, x3. If you do these two subtraction, out of these two, there would be one equation here, and another two equations would be here. So there would be total three equation with respect to x1, x2, and x3. Now use that three equation only whenever you are solving for x1, x2, and x3. This is a fixed steps which you need to perform every single time in order to do your calculation. Remember this. फिर ठीक है, एक बार ये equation आ गया ना x1, x2, x3 में, and this also you get in x1, x2, x3 now, then it's pretty simple and straightforward to do it. But before that, you have to ensure that you get one equation out of these three in the format of x1, x2, and x3. Okay, this is a very important step. If you don't do this step, your answers would be different as compared to what the solution is, and they will give you 0 marks. Understood, Devraj, Abhi?
Yeah, sir.
Yeah, cool. Okay, let's start chapter 7. Then yes, we can end it out. Single index model. Single index model. I guess everyone got a chance, right? If anyone did not have a chance, just let me know. I think everyone got a chance. So I'll just take out few people on random, okay? Single index model. Okay. First, what is the formula for single index model? Let's just write that Ri is equal to, who wants to say? Devraj to hi bol de.
Ri is equal to alpha I plus bi in Rm.
Beta I Rm.
Rm.
So what we are trying to do is we are trying to establish a relationship of your market with respect to your asset. Market with respect to asset. I'm just telling you a real life perspective example. Obviously, there is an error term as well, but just giving an example about why we are trying to do this. When I say market, I basically mean the index which represents the entire market, which is Nifty 50. Okay. For example, I am modeling, let's assume I'll just give name of three companies. If you have any companies in mind, more than happy. I'll write Marsons. I will write Igel. Igel is Gemology India Limited. It basically manufactures lab-grown diamonds. This is into the business of lab-grown diamonds. Okay. And one stable company, I'll assume. Let's assume Iker Motors. Okay. Iker Motors basically manufacture vehicles and especially Royal Enfield. It is under their purview. Okay. If anyone know, Marsons is a pharmaceutical based company. These three are the company. I'll take one more example. Let's take some electricity based company, green based company, which was the company which came right now very often. I forgot the name. Vari Renewables. I guess hope everyone might have heard about this. Vari Renewables. Okay. So when you talk about Nifty 50, Nifty 50 has a risk of 1. Okay. Your beta M of your market, the beta of your market, that's your covariance of your market with respect to the market upon variance of market is equal to 1. So that's how you calculate your beta. Beta is, in simple language, beta is covariance of Ri with respect to Rm upon variance of M. This is the formula for beta. This is the formula for beta overall in a general scenario. So beta of a market is considered to be 1. Okay. Beta of market is considered to be 1. Now we'll try to analyze what happens under these four scenarios for a market. Marsons is a newly established company. Okay. Its IPO came a couple of months back only. So since it's a newly established company, it's a very risky company and it's not a very established company. So I'll give beta of Marsons as a company as maybe 2.8. That means that if a market overall Nifty 50 has a volatility of 10%, Marsons has a volatility of 2.8 times 10% means 28% of volatility. Okay. And the returns is also likewise. If Nifty 50 give 10% return, this will give you 28% return. Similar way. IGIL is a lab grown diamonds. And if you see lab grown diamonds have been recently on a very good trend. And I am expecting this lab grown, this company to basically be 5x in the next 5 years. For example, since it's higher risk as compared to the market, I'm going to give, I would say, IGIL because lab grown diamond does not have value at the end of the day. Those value of diamonds at the end of the day is zero or maybe even negligible, I would say. Okay. Not exactly zero, negligible as compared to the real diamonds. So this as an asset value does not have anything great. But the business right now of lab grown diamonds is very good because people are buying that a lot more. Therefore, riskiness is very good. What if the trend basically reverses tomorrow, which is a very big risk? Okay. So I'm giving beta of IGL as 10. Iker Motor is a stable company. So I'll give Iker Motors a beta of 1.3. It's more risky as compared to the market, but less risky. On other hand, Vari Renewables basically is it's a solar panel manufacturing company. Okay, it's an only company which manufactures solar panel in India. Everything else is getting imported. What I'm seeing in the near future is this Vari Renewables is going to be the next biggest thing because solar panels, one, no one is doing it. Second, we are moving, the whole world is moving into a sustainable way of using your energy, right? So since in India, no one is doing this, Vari has a very huge potential to grow 50, 60 times. At the same time, it's in renewable source, which is considered to be less risky as compared to the market because at the end of the day, the demand for electricity, demand for your solar panels is going to go up naturally. So beta of Vari renewables is 0.7. What you are trying to do is you are trying to establish a relationship between your market and your every stock. Again, if you see, there are a lot of other factors which actually impact a company. It's not just market, there are other factors as well. For example, lab grown diamond is basically based on trends. It is based on spending habit of people. Because if people tend to save more, especially in India, uh, if you see your father, they might be more into savings as compared to our generation. Our generation is more into spending habit. So if your spending habit suddenly stops in India, it is going to become a problem. And there are these factors which actually causes an impact. When I say Iker Motors is dependent upon because it exports its bikes, Harley Davidson and everything in the foreign countries as well. So it is mainly depend on your exchange rate, for example, okay? Exchange rate. It is also depend upon the tariff which is set by a country and therefore it is more related to political risk. Political impact causing a lot of factors in Iker Motors. Vari Renewable, you are more related to, I would say, a cheaper way of electricity coming into picture. Maybe I would say nuclear. Okay, that's nothing but some companies which I explained. These are the market is not the only factor, but when we saw a historical trend, to be very honest, we saw that market was one of the major reasons the share price also moved. Uh, for example, I'll just show to you this example. Nifty 50 returns. Nifty 50 returns yesterday. I just want to see 1 day change. Okay. Yesterday, there was a decrease of 1.1% in the market, 265 points down. Yesterday, the same thing I see in IGIL. IGIL. Yep. No, IGIL. I forgot the name. IGIL share price. International Gemological Institute. Nah. I'll take Salasar, for example. Salasar share price. See, Salasar went down by around 0.73% yesterday. Uh, these are some companies. So see, market went by 1%, this went by 0.73. There would be Wari as well. You can see that there are trends in the market which actually causes market price to move. Wari renewable share price. So it went by 2%. So actually, when the market was down, you saw that all these shares were also down. Almost all these shares were also down. See, these are the beta value we assumed, okay? This might not be the real example. I'm just giving an hypothetical example. So when market went down, okay, these shares also went down. So market is one of the most important factors which actually cause a movement in the share price. And since we had only one provision, single index model, okay, that is the reason we took the market model, because it basically considers all the major economic areas. But however, if you were to advance this, okay, you can increase this to multiple index model, which is nothing but Ri is equal to alpha I plus beta I1 R. Sorry, beta I1. What notations are used here? Beta I1 Ri1 plus beta I2 Ri2 and so on. So what are the different factors you can take in multiple index model? You can take GDP, you can take GNP, you can take GNI. These are some of the important factors which you can consider while doing the analysis. Uh, so yeah, these are the major areas in which you can do your analysis. Single index model is just the start. That's why we just started with one factor. It can increase to multiple factors as well. Just understanding the real life example about how things move on, so that you can understand why are we studying this chapter in particular. Real life macroeconomic scenarios plays a very important role while calculating the share price. So yeah, your GDP, GNP, your exchange rate plays a very important role. Let's talk about the formulas. Expectation of RI when it comes to single index model. Okay. Can someone tell me the formulas, please? Sneha, can you tell me the formula?
Should be alpha I plus bi into em.
Yeah, you can do that. That's fine.
Can you hear me?
Yeah, I can hear you.
I was saying that it should be alpha I plus bi into em.
Alpha I plus beta into E. Okay, okay. You're saying the formula only. Yeah, that's right. Can you tell me variance of your single index model?
Variance should be bi square vm plus vei.
So variance of error usually follows a normal distribution with 0 and sigma square. Okay. Just wanted to make this point. Uh, Input data. I want to give it a try. Neil, input data. What are the input data required here?
Yes, sir. It will be alpha I will be n, beta
Okay.
I will also be n. Uh, variance of EI, that will also be n.
And there are two other expectation of market, variance of market. That's two. Total comes to 3n plus 2. This is still less as compared to the other scenarios. But however, you can do that. You can do diversification as well. Diversification. Suhani, did your microphone got sorted out? Can you try it out now, please?
Can you hear me?
I can't hear you.
Can you hear me now?
Your voice is very less. I can hear you, but it's very less.
Can you hear me now?
Yeah, I can hear you now. Please tell me what is the formula for benefit diversification formula?
Yeah, I haven't done 7 chapter, but
हाँ ठीक है चलेगा no worries. That's fine. Simran, can you give it a try?
Am I audible, sir?
Yeah, you're audible. Please tell me.
So actually, even I haven't done the 7th chapter.
शाबाश. मामा, आपने तो किया है, आप बता दो.
So it's beta square P variance of the market. VM.
Yeah. And variance of your error term basically goes to 0 if n tends to infinity.
Yeah.
So let's call it. Yeah, okay. ठीक है. What is the expected okay, this was a single index model. Multiple index model, can you tell me expected return of your portfolio and variance of portfolio, please? I guess I forgot that.
Alpha P plus beta P into EM,
Mm-hmm.
where beta P is the summation summation of xi beta I, and alpha P is summation of xi alpha I,
Mm-hmm.
and the variance is beta square P VM plus summation from I is equals to 1 to n xi square variance of the error terms.
Perfect. Oh, yep, cool. Mm-hmm. Yep. Okay, that was around it for chapter 7. I think we're done with almost chapter 7. Nothing else is remaining when it comes to this sum. Cool. We are done with chapter 7. I don't want to do chapter 8 since most of you guys have not done. Next week, I'm planning to complete the doubt solving of chapter 6, 7, 8. You need to do the sum solving, and that's it. I'll share you the accesses by this week if in case you have paid the fees. That's it from my side. In case if you have any queries, you can wait, or else that's all for today. Thank you. See you next week offline, everyone. Now.